Welcome to StockOdds Odds and End podcast. I'm Dave Singh here with Rob Friesen. Good evening, Rob. How's everything?
Not too bad, thank you.
Yeah, so we're still in this mid-month seasonality kind of range, and we have some eventful things coming up with the Fed, and there's always something to talk about throughout the week. So let's see what the week has here in terms of stock odds and news.
Well, why don't you start with what's on the economic reports side of things here coming up?
Yeah. So in terms of economic reports, we've got home builder index on Monday, building permits and housing starts on Tuesday, and on Wednesday, existing home sales. So a lot to do with housing and housing stocks for the first part of the week.
Okay, stop right there. Stop. So
Sure.
In terms of curating things from StockOdds, if you ended up with exposure to either the home builders or things that go into home building, because I saw, on Friday, for example, some of the packaging, which includes cardboard and even drywall and things like that, some of those industries were under pressure. So when you're curating, the best approach is, if there are economic reports, you could choose to be in that group as long as you had one long and one short, right? Because then you're sort of insulated from the directional movement, and it's just about the relative performance between the two. The other option is just to remove, anything to do with home builders and the building industry out of your list, so you don't have that exposure. Okay?
Yeah.
Carry on.
And we do have two specific stocks on Wednesday. KB Homes and Lennar are reporting earnings as well.
Mm-hmm.
And then Tuesday, there's something APOG. They're involved in glass and metal and aluminum. So there are some building stock plays around this. So I like your hedged idea: be long and short. Don't take too many.
Or don't have exposure is the other option. I mean, you don't have to be involved, but
Right.
just want people to think through the relationship between news and drivers and how that can either add to the statistical framework or it could take away.
Yeah. Good. And then the other big thing on Wednesday is Chair Jerome Powell has a news conference. I think they're going to decide how much they're going to increase interest rates and reveal that. So that's probably going to be the biggest event.
Well, I mean, we already know what's expected on that front, right? So what's baked in is about 90% chance of a 0.75, just because that's been indicated to us. And I think you can look at the bond market and see that it's already factoring that in, and has been for a while. The markets have been factoring that in. And so there's a small chance outside of that we have a full 1 percentage point hike, which the markets probably wouldn't be too happy with. And there's a very, very small chance of 50 basis points. So what's dialed in terms of the odds makers is the 75, which is kind of a given. The surprise would be either the 50 or the full percentage point.
Correct. And then on Thursday, we have initial jobless claims, more job data, current account deficits, leading economic indicators. So some news around that. And then on Friday, manufacturing news, S&P manufacturing PMI. So there are things in terms of the economy, how well it's doing, and specifically that Wednesday is going to be about interest rates and some commentary that's going to be around that. And that's probably going to be the biggest driver of the whole week.
Might as well carry on with additional earnings. You mentioned the home builders on Wednesday, but what are some of the others?
So Monday, we've got AutoZone. Tuesday, APOG. They're in glass and aluminum in terms of building materials. Stitch Fix, that's more of a retail play. Wednesday, we got General Mills, KB Home, Steelcase, Trip.com. And then there's things like Carnival Cruise Lines. I think that was just recently. FedEx, we know, right? So there are still some earnings that are going to be out there, but nothing. I think it's really going to be around home construction and general economic strength in terms of those earnings.
Okay. Alrighty. What else we got here? So we can run through the futures right now. We're seeing the Dow Jones futures up 53 or 0.17%. We've got S&P up 6.5 points, and that's 0.17%. NASDAQ 100 is slightly down, minus 2.75 points, or just down just very slightly at 0.02%. Russell is up 3.3 points at 0.18%. So of the four, it looks like Russell's in the lead with the Dow Jones and the S&P tied. So they're in second place tied, and then the NASDAQ is last. So remember that configuration and see if we're building on that tomorrow. It is interesting to me that it feels like a bit of wait and see regarding the Fed. So the next 2 days could be small range days. If there were going to be larger range days, it would have to come from something else that probably spooks the market. I don't know if you saw the latest, Goldman news that said, the market could fall by another 26% from where it is. If that was the case, it might need some kind of catalyst to get it going, or it just might be a longer term thing that it takes time to get that far down. But I looked that up and calculated it, and it looks like it'd be the highs from 2018 would be our target to the downside. So that's on the S&P 500. So heading all the way down to kind of erase everything that happened from post March 23rd, as we rallied all the way up until the beginning of this year, and that would erase all of that down to kind of a halfway point in the fall of COVID, where we had reached a high in 2020, and then at the beginning of 2020, and then we fell from that. So if we retraced back to the highs from 2018, that's kind of smack in the middle to 2/3 of that move down. So they're not calculating all the way down to the low of COVID, March 23rd, 2020, not that far down, but still markets wouldn't be happy with erasing all of this premium, because we've already seen, many stocks within the index that, for example, were more speculative, didn't have earnings, had long range targets, in terms of when they're going to make money or whatever. We've already seen those have significant haircuts of 50% or more, some of them even 80%. So that doesn't really bode well for speculators if we end up drifting down. So I think we'll have to see what happens here on Wednesday with the FOMC. But it's looking like the market's factoring in things, and we're looking at the currency. The U.S. dollar is, it has had a big move up, pulled back a little bit, and it's kind of just hanging around, right? So some of the other currencies are still under pressure, like Japanese yen, British pound, even the Canadian dollar, Australian dollar, New Zealand. So some of the commodity related things. Euro has bounced up slightly only because of raising rates was on the agenda there. But speaking of the Eurozone, really the amazing German growth that we had, based over the last 20 years, that made possible low-cost debt for many of the member nations, the EU budget, and the central bank clearing system. And that has, carried some of these unsuccessful economies along with it. And the problem is that all of the politics surrounding energy, especially coming from Italy, which is really having a problem, is making it sort of more unsustainable that, the Eurozone can stay together like it has. And we've already seen, the UK with Brexit. There may be other countries as well. And then the ECB may be forced to do QE, quantitative easing, at the same time it raises rates to assist some of these struggling countries, to subsidize, the energy problems. So that's going to be an interesting, multitasking thing where they're doing QE and raising rates, because it's usually kind of the other way around, right? They do QE and lower rates. So, but their balance sheet is growing, so I think they're already doing some QE. So that's it's interesting. I mean, we may be in the generation we see this whole, what would you call it? Well, it's kind of like, you assemble something and they're all different countries and very different cultures, and you assemble it for some common good. I would call that an experiment, right? And we may be coming to the end of this experiment. It's possible, right? Can you imagine? So, I mean, that changes, that puts stress on, banks. Some banks have, hold a lot of euro, because it's good to diversify in currencies as a bank too. So, and, there's a lot of systemic problems that could happen from that. But anyway, what else we got going on? Okay, energy. I'm seeing a bit of an uptick here on energy this evening. We're seeing it up 0.73 on West Texas crude, so that's 0.86%, almost a percentage point. Brent crude is up a little bit more at 0.93%. And in the other commodity area, metals, gold not doing too well. Silver had a good little few days streak, but it's kind of taking a bit of a pause here. It's up slightly, 0.23%, whereas gold is down. So a little bit of a divergence going on there between gold and silver. You might want to look to see if it's a reversion to the gold-silver ratio that occurs in the ground. I'm not sure, but there's plenty of room for silver to shine with gold not doing anything. Platinum up slightly, copper up just slightly, but the metal's not really showing much. And the bonds, bonds are heading down, and they're down tonight, before tomorrow. Again, probably factoring a little bit more of a risk of maybe the Feds want to do 1 percentage point. Right?
Well, how about this? Because the last couple of days of the month are probably the best for September, and
they are generally, historically
already. I mean, typically I think the market's it's down like 0.19% for the month, and we're down 5 or 6% for the indices, right? Like the Nasdaq and the Dow. So we're so kind of oversold basically relative to that. If we come in with the 75 basis points and nothing new or unexpected there, could we see a outsized rally because we're so discounted?
I think what they're going to be leaning on is not just the hike itself, because that's already being factored in, and we pretty much expect the 75 basis points, but it's language to support a more aggressive and longer term run, because some of them have already moved their targets, like some of the banks have moved their targets to more like 4.25, in terms of, rather than the 3.8 the Fed was targeting. So I think we're going to be listening carefully to see if it's more hawkish or more dovish, and that's probably what's going to set the tone for the rest of the week, right? Now, if there is a surprise and 1% and the market really tanks, we could have, a couple days down, and we might get it out of our system and bounce back, right?
And then also,
that'd be kind of cool. Like if we really got discounted before the last week of the month, and we have a positive expectation, then you have that divergence before seasonality, right?
Yeah. And the other thing is, we still have that inverted yield curve. That the 2 years at 3.87 and the 10 years at 3.45. So still quite a bit of difference there still indicating recession or recession risk.
Well, and the World Bank came out with, that a couple of days back about the risk of a global recession. So not just, US based, but really this is a global situation. That's what's kind of been keeping a bit of a lid on oil. Two things keeping a lid on oil would be the strength of the US dollar. And now that that's kind of a bit more sideways, oil could shine a little bit more, but the global recession thing also is putting pressure on it. So, but anything to change in that in terms of, we're going to be past the worst of it sooner than you think. I mean, we've seen that summer rally where everybody got hopeful, right? And that could happen again anytime. Prices can be divorced from reality for a period of time. They don't have to. It's not correlation where everything always marches along to the exact narrative or the news or the macro. It can become very disconnected. But just remember that that's one of the things we look for is, what is the expectation? What are the odds? What's the seasonality? And how diverged are we from that? Because it would be completely different, to go into the end of the month where we already had a massive rally for all of the rest of the first 3 weeks of September. And, now it says we're supposed to be up the last week. That's where people get into trouble, is they don't factor in what already happened, and that, wait a minute, we have a positive expectation for the last 5 days of the month, but we already outperformed it handsomely before we ever got there. That puts more risk into the equation. That puts less opportunity, less of an edge. Okay?
Very good.
All right. Well, wish everybody a good week. I think we covered most things here. So we'll, let's see what else we got here. No, I was looking at, there's a CME Fed Watch tool you guys can look at, which has target rates for, and the probabilities associated for, the time horizon all the way into December 2023. So it's what a lot of bond people look at to, give them some direction on the right sentiment, I guess. Okay, let you go. Take care.
Good luck.
Yeah, bye.